Hey everybody, Michael Wagner, one of the co-founders here at Omnia Family Wealth. And I'm joined today by Alon Ozer, the Chief Investment Officer here at Omnia Family Wealth. Hey Alon.
Hey, Michael.
It's good to see you. It's been a
You too.
while.
It's been a while. Good to be in the office.
Yeah. So look, it's 2021. We've had a really, I think, challenging year behind us, but we're starting to look forward, right? So we recently did a piece on the market outlook for 2021, and I think a really big part of that is the fixed income environment. What's going on in the bond market? Now, we have a new Treasury Secretary, there's a new administration. How does that factor into the thinking?
It is factored into the thinking. The administration, they're obviously doing things a little bit different, but it's important to always take a step back and understand how they operate within the overall framework, within the overall environment that we're in. And for that, I want to take a step back to the last quarter of 2018. We wrote a memo back then. We called it the long-term debt cycle, and the reason that we wrote it was because we saw that something is changing. And what we talked about in the memo was what happens to the macro environment once interest rates hit the zero bound, because our system is not built to deal with something like that. So a lot of side effects are gonna come up once you do that. And sure enough, the Fed tried to raise interest rates. The equity markets got scared. They dropped about 25% in the last quarter, and obviously that was the taper tantrum. And obviously the Fed did not raise interest rates, and that was the first signal that we are in a different environment.
And that's all the way back in 2018.
2018. Everything that we see, it's a very long cycle that happens, and things develop slowly in that system. But it's critically important to understand the environment before you make any investment decisions, before you even try and understand what's going on in the fixed income market. And so just to give you an example of and it's something that I don't think most people or investors understand, is that we are in an environment where for the first time in maybe 75, 80 years, every time we would see growth in the market and yields are going up with the growth and a little bit of inflation, traditionally, and that's what we were taught in school, the Fed will tighten, right? They will raise interest rate. When that happens, the Fed lowers interest rates because the markets cannot handle higher interest rates. And this is a very, very big deal because the system is upside down. It's working very different than the way it's supposed to work. And we see it just recently with the 10-year. It got to a certain point of 1.6, and then the market started fluctuating a lot because they just cannot handle it. So this is the overall environment that we're in. When you understand how markets operate within that environment, it puts the fixed income market in a very big, it's a problem. It's a problem because there is a high probability that in the next few years, you're on the good scenario is you're not going to make any money in the fixed income market. The bad scenario is that you might have significant losses in this market. And if we go back to the 70s, fixed income investors basically got wiped out. So I'm not saying we're going to get there, but it's a possibility.
No, but I think that's a really important point because I think so many portfolios have been built with the idea that your bonds, your fixed income, or the stable part of your portfolio, and they're there to protect you in turbulent times. So how does everything you just said play into how you're building portfolios and the way that you think about the very fundamental construction of an investment portfolio?
Yeah, that's hugely important. It's basically the 60-40, we call it, where you have 60% in equities, 40% in fixed income, and then the portfolio is balanced. That's no longer the case. This is something that we used to do. At this point, we think at least fixed income investors that are buying the public fixed income, they own more risk in their portfolio than return. The risk on these bonds are higher than the return that they are going to provide. That's one thing. The second thing here, the whole function of that 40% in a portfolio is not going to work. We saw that in March, actually, of last year, when the market took a dive, the equity markets, fixed income went down with it. So if you had only fixed income and equities, it was impossible for you to rebalance the portfolio afterwards.
Right. And the concern there is, look, that was a very, I think, short-lived correction in the markets.
Correct.
And things bounced back very quickly. But that may be a preview of how fixed income may not be the stabilizer that we've traditionally been able to depend on it to be.
That's absolutely true. Absolutely true.
And you mentioned how much risk there is in fixed income. Is that coming from like the credit worthiness of who people are lending to in the fixed income market? Or is it more a function of where we're at in the rate cycle, or potentially a combination of both?
Correct. It's a combination of both. Obviously, the market has been running for since 2008 basically, and become a little bit toppy, and we see covenants are lower than they used to be. So yes, the quality of corporations who are issuing the debt is lower. So we see that. We see a lot of triple C's. We see a lot of, so that's one thing. In terms of the environment, and I think that's actually the more important thing to understand, is that fixed income investors face basically a no-win situation here. Because on the one hand, if rates stay where they are, it's zero. They're basically not going to make any money. On the other hand, if rates go higher, they're going to lose money. Right? So that's, now let's try and think what the Fed is trying to do, what the administration is trying to do here. In order to keep the equity market where it is and help it go higher, they need to keep interest rates low. Right? And we have to remember that they're coming with major stimulus packages, right? So that's more money that's going to be printed. That's more debt that we're going to accumulate. So that's one thing we have to remember that. To keep rates lower, the Fed has to buy enough treasuries in order to keep it down, right? So the Fed is going to push interest rate to make sure that interest rates stay low in order for the equity market and the economy to stay afloat. And this is actually an important point, because at this point in time, the Fed is more concerned about full employment than on price stability, right? Which is also a shift in terms of the environment and how the system now is gonna operate. So for the fixed income investors, they're basically between a rock and a hard place, right? You want to keep the equity market afloat, so you're going to keep interest rates down. Mm-hmm. That's great, but the fixed income is not going to do anything. If they're not successful, the Fed is not going to buy enough treasuries, rates are going to go higher, fixed income market is going to tank.
Right.
So there's no win-win.
And I think so much of what's gone on is by having interest rates so low for so long, the Fed is really pushing people to get out of the bond market and go into other things like the stock market, where they can potentially earn higher returns. And you're really forcing people to take on more risk than maybe they would have done 10 or 20 years ago.
Yes, absolutely. Absolutely. In the last 12 years, savers have been punished. There's just no interest rate. It's either you get your zero interest rate or you go into higher risk, potentially higher return assets.
And it's funny you mentioned that, because we've talked a lot about recently about, like, I would call it animal spirits in the market. You're seeing people being attracted to some things that don't necessarily make a ton of sense to us. I'll point out SPACs in particular. You saw all of the frenzy around GameStop. You're seeing a lot of people, I think, going into things they don't fully understand, and markets may be pushing them to make decisions that may not be in their best interest.
That's correct. I think it's more related to the recent stimulus and the fact that people stayed home for so long. They got checks, they were able to spend it, and statistics shows that most of the money went on on some they spend, some they save. They spent it, they spend it on financial assets.
Yeah.
So it's not really helping the economy, but that's what they did. What we see around SPACs, what we see around, and SPACs, and I have nothing against it. That's a legitimate vehicle, absolutely. It's just the amount of money that's been raised and the type of deals that have been done. If you look statistically over deals, most of them are not good. Some of them were great, of course, but it's not. It's kind of a trend at this point.
It's very similar to the way I look at like hedge funds, right? Hedge funds are a structure. There are some very good hedge funds. There are a lot of not wonderful hedge funds.
Correct.
And I think SPACs kind of have a similar structure to them.
100%. And at some point, people are going to hate them because they're not going to do well, and then they're going to love them again because they are going to do well, and that's.
So you mentioned stimulus a couple of times, right? And I think we had a round of stimulus right around the outbreak of the coronavirus. And now we're discussing like an infrastructure-based stimulus package as well. What has been the impact of that stimulus on the real economy? How does that play into the interest rate discussion? I think you've touched on that a little bit. And then at the end, like, what does it really mean for people's portfolios and even their lifestyle? What is the net effect of the printing of all of this money?
Right. That's it's a question with a complicated answer, so I'm going to try to maybe break it down. In terms of the stimulus, what the Biden administration is trying to do, and I think it's a great idea, it's just very late. We basically, the U.S. stopped investing in infrastructure back in 2008, completely, and that's catching up with us. So in order to encourage the economy and rebuild America, they're gonna come up with a major infrastructure plan, which is absolutely great for jobs. It's great for the economy. The problem is, how do you pay for it? So they're talking about raising taxes. Where's it going to come from? Who's it going to hurt? Are they going to be able to pass the bill? These are things that we still don't know. But again, what we need to do is to take a step back, look at the overall framework. What is happening? In order for us to be able to spend so much money, raise taxes at a normal level, not too much, and basically issue tremendous amount of debt in order to do that. There are some things that have to change. And something very interesting is that in I think April 5th, I think, Janet Yellen came with this tweet that she's talking about. She's comparing what they're doing in their administration to the Bretton Woods agreement, which for those who are not familiar with it, after World War II, the major countries met in Hampshire and Bretton Woods, and what they did is they decided, because most of the gold was in the U.S. at that point, most of the other countries were actually broke after the war. They decided that they're going to fix the price of the dollar to gold at $35, and the rest of the currencies are going to be at a fixed rate against the dollar. So basically, the dollar became the gold of the rest of the currencies. So that was a major thing. So now she's talking about Bretton Woods. What's so major about what you're going to do? And from what we understand, what they're looking to do is basically to raise tax levels, but not only in the U.S., with all the other countries that the U.S. actually works with, all their allies. And why do they try to do that? Because they're trying to first, if you raise interest rates here and other countries have lower tax rates, and that's what's happened, money is going to go over there. Corporates are going to do over there. But if they raise it across the board, and they put a couple of other limitations on corporates not to move their intellectual property and assets and things like that, then it's going to be less. So they need to raise the taxes. They don't want the money to go out. So they're trying to do it across the board. So that's what she says.
Global tax regime.
Exactly. So that's kind of what they're trying to do. If it's going to work or not, it has a lot of implications that it's too long to talk about. But this is something that is important for corporations to understand, for individuals to understand that that's kind of the objective. And what does it mean for the US dollar? What does it mean for the US dollar? At this point in the cycle, a strong US dollar is not good for us. That's actually going to prevent them from doing what they want to do.
So, to wrap this up a little bit, there are a lot of forces going on in the fixed income market that are distorting the risk return parameters in other markets. So, Alon, when you're looking out there, where are the opportunities and where are the risks?
So the risks, we're talking about the fixed income market, the risks are mostly in the fixed income market, and especially in interest rates. If interest rates go higher, we think both markets are going to get hit, equity markets and the fixed income market. If rates stay where they are, even go lower, we think the equity market is going to be okay, but the fixed income market is not going to do great. Just no returns there. Opportunities we see mostly on the private side. We see them in private debt. We see them in real estate debt, which is something that's very interesting, especially post-COVID. We're a little bit smarter after COVID, and we can focus on the assets that are can perform better. It's floating rate debt, which is something that's great in this environment. The other area is hedge fund, but specific small sector in the hedge fund world, which is lower beta strategies that can generate the 7-8% that you need for your portfolio without the fluctuations of other equity hedge funds. This is just an example, but these are some things that you can do in your portfolio in order to keep the income that you need, the return that you need, with the stability and not really taking the risk. Because really, in most fixed income instruments that we look at, the risk is much higher than the reward, and this is something that we would recommend to avoid.
Yeah, so I think that's really important, that the risks in your portfolio may not be where you think they are. They may not be where they've been for the last 20 or 30 years. So to be very mindful of your allocation and the role that all the various parts play in your portfolio. So this was just one part of a multi-part series where we're going to get into the nitty-gritty on a lot of stuff that applies to your portfolio and markets and the economy. I want to thank you for spending a little bit of your time with us today. I want to thank you, Alon, for spending some of your time with us as well today. Sure.
It's fun.
Thank you so much for being with us. As always, please consider your source. Have a great day. We'll see you next time. Thank you.